Welcome back on Indianomics. We have been parsing the first quarter GDP numbers, and the key question that I have in my head is from the 6.8% GVA, can we make it to the magical 7% mark? I've been speaking with Abhishek Upadhyay of ISec, Madhavi Arora of Emkay, Sonal Varma of Nomura, and Samiran Chakraborty of Citi. Well, let me ask you that, Abhishek. What are the chances that we will be able to, because of the improved consumption and the clear fact that the government will spend more on capex, what was lost in the April, May, June months will be, overdone, made up for. What are the chances we get to 7?
Rather, we have retained 6.8% forecast for GVA, but I do agree that looking at the internals, with capex growth staying resilient despite a near collapse in government capex, and for context, government capex is roughly about 25% of overall capex, and we saw a sharp contraction there with resilient capex, with consumption demand, there being scope for it to pick up. Also on the global side, what we are seeing is the worst case scenarios are not playing out. So you have increased talk of soft landing in US. Also commodity prices, which had risen earlier in the year, are now at levels which are below the current calendar year starting levels. So the headwind from adverse terms of trade shock also seems less severe than what we were thinking earlier. So given all these drivers, uh, uh, there should be some case for optimism, and more likely that we are going to revise our number higher rather than lower. So
Okay.
GVA growth likely stays here slightly higher, and GDP growth, which we are currently penciling at 6.5%, could be closer to GVA growth as well. So these internal support case for upgrade rather than
Okay.
downgrade in our view.
Okay, so 6.8% and the a chance of an upgrade. Madhvi, what would you say? Uh, are you finding the private capex and the likely government capex positive enough to engender 7%?
So, Latha, we are maintaining our forecast 6.5%, which is what it was, I think, 6 months ago. Also, I was of the view that we will be seeing a slower manufacturing story in FY25, and that is what I maintain. And for that matter, consumption also looks to be a very patchy story as of now. Of course,
Okay.
rural is picking up. You are looking at signs of rural pickup, which is as reflected in in two-wheeler sales, and lower Manrega demand as well. But at the same time, even as the rural consumption lifting, you are seeing that the urban consumption appears to be slowing. If you look at the data for four-wheeler sales or even hotel occupancy rates or even consumer-rated lending in general, you are looking at a much slower urban story, or maybe a K-shaped urban story for all you know, wherein the mid segment of urban actually would see a much sharper slowdown. So I think it's still too early to assume that we will be seeing a 7% growth. As of now, I'm still sticking at 6.5%. Of course, there are some tailwinds which are basically emerging in the form of strong monsoons and a
Exactly.
recently, a decent pickup in the rural consumption. But
Okay.
at the same time, you would have headwinds in the form of urban consumption, in the
Okay.
form of manufacturing growth, which will be slowing
Okay.
on account of the
Got that.
higher input cost.
Yeah.
At the same time, the deflator-led push that you got last year would also sort of fade. So I
Okay.
think to a large extent, I'm still more biased towards 6.5% than towards the
Got that.
7.
No,
As of
got
now,
that.
pretty
But
much
no, I
balanced.
take your point about the K-shaped. I mean, after all, look at trade, hotels, and transport. It has just not got back the mojo that it had pre-COVID at 5.7%. And it's a fairly employment-heavy, informal-heavy sector. That's a worry. And so is agriculture. But Samiran, agriculture could be the positive, isn't it? We have a La Nina year. The rains, August rains have been excellent. There is a very good chance that the Rabi will be very good. So, what are the chances that the only thing that is keeping the Reserve Bank from cutting is food inflation, which could be, the peak is completely over. And we saw, I think the nowcast is showing cereal and pulses prices, even veggies, other than potatoes and onions, crashing. A rate cut possibility and your growth improvement chances.
So clearly, agriculture, all the indicators from the monsoon has been quite good. It's not just the quantity of rainfall, but also the quality of rainfall. the temporal and spatial has been good. Also, the sowing pattern has been exactly in line with estimates. So, barring any random shocks from unseasonal rains or heat waves, this should be the rest of the quarters should contribute very positively agricultural growth towards GDP growth, which is why I was mentioning that we could get compared to the first quarter another 30 basis points is extra on GDP growth coming from agriculture itself. Now, whether this contributes to cooling down of inflation beyond what we have already budgeted, that remains to be seen.
No, but the second quarter is, one minute, let me interrupt. Second quarter is definitely not 4.4. The Reserve Bank's forecast seems to be clearly higher, especially when you see the nowcast numbers for food. So you don't think that there is a chance of an undershoot of 4.5, no?
So the point is that the central bank has been very clearly articulating that they want a 4% headline CPI on a durable basis. Now, yes, it could be that this quarter would be slightly lower than the RBI estimates, but if the base effect will catch up on the other side, in the next quarter, we're going to see numbers which are probably in the 4.5 to 5 range. So would that be comfortable for the central bank to cut rates? At this moment, the communication seems to suggest that that's not the case, which is why we haven't brought forward our rate cut expectation. What could change things is that if for some reason growth numbers disappoint, maybe because of the global shocks, then the balance of risks could change. Right now, the balance of risks is entirely towards inflation. That could be more normalized and could bring forward rate cut expectations.
Okay. Well, yeah, there is, of course, the global risk. There is the November election. So we really do not know whether these imponderables will come. But Sonal, you're the only person I know from the many reports I've read who has lowered, and I think Goldman has also lowered earlier their growth forecast. What will be the falsification thesis? I mean, what can falsify or make you give an upper thrust to the GDP?
Yeah, Latha, I mean, I think some of the, high frequency numbers that are moderating, if they don't moderate, and you see alongside that, some of the transitory factors that pull growth down in terms of government spending or heat wave, that's a scenario where growth gets closer to 7%. So essentially, we're talking about, credit growth staying strong, consumer demand coming back in a big way, construction-related indicators picking up again, and potentially also I'd throw in the mix the global backdrop. I think it's still quite uncertain in terms of the path ahead. But if we do get a soft landing in the US, that's actually pretty good for India, because if you have soft landing in the US and a relatively soft China, then you have, easier financial conditions, better growth, and low commodity prices. So that combination could also be quite positive for India.
Okay, yeah, absolutely. The last US GDP number for Q2 has been revised up from 2.2 all the way to 3%. So I'm not very sure that the much feared global slowdown is as yet with us. Probably some more data is needed. I'm told that we are out of time. So just a rapid fire, just give me your full year GDP forecasts. Abhishek?
Still 6.5, but upside risk.
6.5 with upside risk. Sonal?
6.7% for FY25.
And Samiran?
We are at 7.
7. Madhavi?
6.5%.
Okay, fine. So, well, it's a city which is more confident than the others, but others are also, at least Abhishek has an upside risk. Thank you very much, Madhavi, Sonal, Samiran and Abhishek for sparing time for us and for an extremely interesting and enriching discussion. And thank you all for watching Indianomics.